Tell me about how these rising rates have affected munis, because it depends on
Sure.
the
Well,
muni.
it does. It does. The rates have actually been rising since the middle of 2016. Even coincidentally with that, municipal bond annualized returns have been positive since that time. Now, on a year-to-date basis, they've risen a bit more. On the long end of the yield curve, muni rates are up about 100 basis points on a year-to-date basis. So for high-quality municipal bond indices, they're down about 80 basis points in total return on a year-to-date basis. High-yield municipal indices are up between 3 and 4%. So it's been a resilient performance to the market overall this year. I think when you think about entry point, you think about cash flows and income, tax-exempt income that you can generate going forward. And this environment actually improves those forward-looking returns.
So you think this
today
is potentially an entry point as maybe the rise in yield slows a little bit?
Yeah, historically, when we've seen a 100 basis point sell-off in munis, a little bit of outflows here in October, the fourth quarter has been a good time to put money to work in anticipation of a bounce back in the marketplace in 2019. Another way to look at it is how much tax-exempt cash flow in comparison to where inflation is. So the core PCE deflator, it's up marginally from 1.8% at the beginning of the year to 2.0% right now. But again, with muni rates being up 100 basis points, that creates a better after-inflation, after-tax return profile going forward.
John, what's the sweet spot when it comes to the credit quality of munis? Is it, high quality investment grade? I mean, I don't know what kind of yields you're getting there versus, say, a triple B, which is still investment grade, but of course lower on the scale.
Sure. Of course, it's very case by case. A lot of essential revenue bond projects are in the triple B area, but have some upside potential when those projects get completed. The redevelopment of LaGuardia Airport being one example, yielding in the 4.25 area for longer term. High quality municipals at the longer end of the yield curve, 3.5 to 3 3/4, triple B cuffing that in the 4.25, in some cases 4.5 range. So it depends on your appetite for credit risk. I will say that the economic strength has really accelerated, as we know, in 2018, and that is benefiting state and local government revenues as well as selected infrastructure projects.
So let's say I want to go into a fund or an ETF as opposed to dabbling in the individual bonds. What are the characteristics of the fund that would work best right now?
Sure. Well, in terms of funds versus ETFs, funds have more of a credit selection or security selection bias as opposed to just replicating the market. So it depends on what you favor there. And funds have short, intermediate, long-term, and also high-quality, mid-quality, or high-yield. A lot of investors with whom we work will have a core of intermediate high grades, maybe 60–75% of the muni portfolio, with a 25–30% chunk of high yield to tap into non-rated and lower credit quality.
How would you expect a portfolio that is administered that way to perform over the next 12 to 24 months?
Well, I think as soon as we get a little bit of interest rate stabilization, so all year long, interest rates have been the headwind, but municipal specific characteristics like the tax exemption and like improving credit quality, moderation of supply, those have sort of been the tailwinds. On a going forward basis, I think as soon as rates stabilize, we'll probably see a bit of a rally, and you would earn coupon plus some capital appreciation. Probably a portfolio position, the way I described, probably earns total return north of 4% in the next 12 months.
All right.
Maybe 5% if some positive developments occur.